Today, the world is about to witness one of the greatest retail apocalypses in history. Some of the biggest retailers that have stood the test of time are about to be torn apart by bankruptcy. Over a dozen significant retailers have announced plans to close more than 1,400 locations in the U.S. in 2023. Shockingly, some of the biggest brands are among the retailers closing locations, including Amazon, Bath & Body Works, Walmart, and Foot Locker. Trust me, you'd be shocked when you find out some very big companies are about to go bankrupt. Before we jump in, please make sure you like and subscribe to help No Cap Capitalists can keep producing more content for you. Thanks. Now on with the video. According to Axios, there were 52 retail bankruptcies in 2020, but just 21 in 2021, a 60% decrease from the previous year. Only a few businesses went out of business in 2022. However, it doesn't necessarily mean that retail is in the clear just yet. As a matter of fact, retail bankruptcies will increase this year due to shops having to deal with both new price increases and a decline in consumer spending. This is in addition to dealing with their long-standing challenges. You can check out the list to see if your favorite retailer is on the brink of falling apart. At this moment, here are the top 15 retailers on the verge of collapsing. Number 1. Party City. In 2020, Party City entered the pandemic with worries about its finances and market share. It was a single leverage buyout and is still heavily indebted. Since 2019, generalist and digital players have started eroding its brick-and-mortar Halloween City business. Eventually, the company's sales plummeted as a result of the health concerns associated with simply being around people. While parties and sales have partially recovered from their pandemic lows, Party City also had to contend with shortages, high operating costs, and other difficulties. Overall, retail sales for the company decreased by 4.6% in the second quarter, while the gross profit margin decreased by 680 basis points. Number 2. Digital Brands. Less than a year after becoming public, Digital Brands Group added wording to its securities and exchange filings indicating that, in the absence of fresh funding, it would be required to file for bankruptcy. The company has now raised additional capital, but throughout that time, it has accumulated enormous losses. Additionally, Digital Brands has faced legal action from creditors for making late payments. One of those creditors required Digital Brands to postpone its expansion plans until it received payment for goods that were delivered years ago. The business generated $3.7 million in revenue in the second quarter, and its operating loss was roughly $10.7 million, significantly less than it was the previous year. Number 3. Independent Pet Partners. The Independent Pet Partners also filed for Chapter 11 bankruptcy in February. The company blamed its financial problems on consumers' waning interest in the grain-free, high-protein dog chow it sold in its stores. With temporary store closures brought on by the epidemic, its revenue losses only grew worse. The business decided to discontinue its Natural Paws and Loyal Companion brands as well, and even shut down some of its current locations as part of its bankruptcy restructuring. Number 4. The RealReal. The RealReal is one of a group of e-commerce experts that went public in recent years despite a track record of losing money. The company's sales increased by more than 40% between 2018 and 2020. However, the luxury resale market struggled during the pandemic and the accompanying downturn in the apparel industry. As the business concentrates more on profitability, the founder decided to leave her position as CEO after 11 years. Unlike other businesses in the digital sector, the RealReal has been expanding its workforce after labor shortages made it difficult to acquire merchandise. The company's revenue climbed by 47% during the most recent reporting period, but the average order value decreased as a result of customers switching to cheaper items in response to inflation. Number 5. Bed Bath & Beyond. Since the pandemic started, Bed Bath & Beyond has been experiencing ups and downs. The retailer's sales soared as customers started turning to the homes they were stuck in during the era of social estrangement, and a long-desired turnaround seemed to be taking root. However, last year's supply chain problems and the subsequent decline in discretionary spending drove down sales and profits. After the company's dismal quarterly results report this summer, Mark Tritton, who joined from Target to manage Bed Bath & Beyond as CEO starting in 2019, resigned from his position. Ultimately, Bed Bath & Beyond adopted new debt funding. a strategy to eliminate over 150 shops, and a plan to reduce staffing levels in an effort to once more bring the company back to its original status. Number 6. Tuesday Morning. One of the pioneers of the off-price business, Tuesday Morning declared bankruptcy in 2020 as a result of years of losses and subpar sales while attempting to take on the off-price Goliaths. The business filed for bankruptcy last year, closed its stores, and secured fresh loan financing. Tuesday Morning's profits didn't change significantly when it reduced the number of stores it operated during the bankruptcy or the spike in home goods purchase that occurred during the pandemic. The company's most recent period saw comp sales climb by 8%, while its net operating deficit went up more than $10 million from the prior year, and its gross margin rate contracted by more than 7 percentage points. Number 7. Walmart. One of the most well-known brands, Walmart is aiming to reduce its high street presence this year. Due to weak sales, the venerable retailer is closing 5 big box stores and its final 2 pickup-only locations. The Walmart store closures follow the company's annual practice of closing a number of locations across the country. This year's target states are Illinois, Wisconsin, New Mexico, Florida, and Arkansas. By the way, please remember to like, subscribe, and comment. Number 8. Big Lots. As the retailer shifts its focus away from cities and toward rural villages, Big Lots has decided to close many of its locations. The bargain retailer has shut down outlets in Colorado and California's urban and suburban areas. Despite having launched 50 new locations in 2022, the number of closures was similar or slightly higher. According to Ramsden, some of those closures are taking place because Big Lots intends to resell the store locations. In other instances, the business says it is shutting down unprofitable stores. 7 Big Lots locations will also close this year as the bargain retailer looks to target rural towns and steer clear of cities. Number 9. Boxed. In April, the e-commerce site, which sells bulk consumer products, was declared bankrupt. The months before its filing saw a gradual emergence of warning indicators. For instance, last year, both its stock price and market valuation fell below the bar for New York Stock Exchange listing. Furthermore, the Silicon Valley bank crisis, where it kept the majority of its cash deposits and other liquid assets, probably made its problems worse. In the midst of bankruptcy proceedings, Box declared it will shut down its retail business and sell its software division. Number 10. Serta Simmons. Recently, Serta Simmons Bedding filed for Chapter 11 bankruptcy protection in January. With regard to the emergency funding it received during the pandemic, Serta had already been dealing with ongoing litigation. Sales declines brought on by more recent macroeconomic turmoil fueled the fire. The business went to restructuring in an effort to reduce its $1.9 billion debt load to $300 million. The mattress business also took action to end the legal dispute over its finance from the pandemic era to assist its restructuring. Number 11. Wayfair. In the world of home products, Wayfair has grown significantly. Only a few companies can compete with it when selling home goods online. However, the company has been losing money since it was established. Wayfair generated an operating profit of more than $360 million in 2020. Back until 2011, the business had reported a net loss for each and every year before that. Even the profits it generated in 2020 during the peak of the home goods and e-commerce industries were at the expense of a precariously low operating margin. Wayfair was once again in the red last year. According to global data, the company was the only leading e-commerce retailer to experience a revenue decline in 2022. Number 12 and 13. Genesis Global and Auto Plus. Also, Genesis Global and Auto Plus were both declared bankrupt in January, making it the busiest month for big U.S. bankruptcy filings for businesses in 13 years. Rising interest rates will hurt deeply indebted businesses, especially those with floating rate debt. The increase in filings comes as a result of months of accumulation in the number of bonds and loans trading at distressed levels in the Americas, which is more than 3.5 times greater than it was at this time last year. Number 14. Siku. The business initially declared bankruptcy in January 2022, but later withdrew the claim. Initially growing, Siku expanded from a second-hand handbag market to become the biggest luxury e-commerce platform in China. In 2017, when it went public, it raised $140 million. That year, its net profit increased. However, the pandemic's increased competition and falling consumer spending made it difficult for the company to remain competitive. It also had to deal with the wide range of other connected issues, such as complaints about consumer rights protection, sales contract disputes, and false advertising accusations. Despite its filings and the surrounding commotion, Seiko declared at the end of August that it had made agreements with 2 new investors. Number 15. Escada. The U.S. division of the upscale women's clothing company Escada also filed for Chapter 11 bankruptcy in mid-January 2022. Although the pandemic was a major factor in Escada America's bankruptcy, the branch had been facing numerous problems for years before that. After Escada USA declared bankruptcy in 2009, Escada America was created as a result. In the years that followed, the global Escada organization struggled with overexpansion, poor leadership, and exorbitant lease prices. As part of the bankruptcy process, the company has agreed to liquidate 5 of its 10 U.S. facilities, and it intends to reorganize and pay off its creditors. In the upcoming months, more retailers will probably be forced to the breaking point. According to Fitch Ratings, the default rate for U.S. retailers with junk ratings might rise to 12% this year from a nearly all-time low of 0.2% at year's end. With $67 billion in outstanding bonds between those companies, this is around $8 billion at stake. But then, these figures will only continue to increase from this year onto the next and to the next. Among these big companies that are about to go bankrupt, which one shocked you the most? We'd love to know your thoughts in the comments section. If you enjoyed this video, make sure you click the like and subscribe buttons. Most importantly, don't forget to click the bell icon to be notified when a new video is uploaded. Also, feel free to leave a remark if you have any recommendations for videos. From No Cap Capitalist, have a great day everyone, and thanks once again.